Here is an important update for the Economic and Financial Ninja series. And the headline is Warning, and it's also an opportunity. It's a big warning and it's a big opportunity. First, I'd like to thank the people who covered the costs of a new computer. You'll see that this update is dated for July 2021, and that's how long I've been waiting to present it to you, because the warning period refers to this month, September, October and November. So thanks to the people who sponsored me for the new computer. Without your help, I wouldn't be able to do reliable videos and updates. So let's go straight into the content. We're looking at the big picture, which is 100 years of the Dow Jones Index. And I'll read this out. On the very long term, 100-year chart, the Dow Jones Industrial Index moved in the upper area and band in its very long-term rising channel since 2017. This happened only twice before, in 1929 and 2000. Right now, the index is not far away from an extreme. Most likely this bullish risk-on cycle, and that means people who are willing to take on risk because they perceive that there is low risk, will bring the Dow to the top of its channel before falling back to the median line at a certain point in time. What does this mean? It means that we are at a twice in a century extreme. And the fact is that when these extremes correct, they tend to go either to the median line or, as in 1929, well below the median line. And in fact, that's what I would expect in this situation. Why? Because we have never had a global market with bubbles in virtually every area before. The whole thing is a house of cards, and when this collapses, things tend to swing in the opposite direction. So I'm expecting an absolutely epic drop. Here's another piece of evidence, which is the Buffett indicator, which shows value versus historical trend since 1990. So I'll refer you to the left-hand column, 0%, which is the historical trend line, fairly valued Buffett indicator. And now if you have a look at the blue graph, what you see on the left-hand side is the internet bubble at plus 67%. So that was the dot-com bubble, and that took 13 years to return to the same levels. The bottom of the financial crisis is the next feature, 2007, 2008, where the markets fell 48%. And now let's look at the top right, which is the 15th of July 2021. That is a 234% ratio of market capitalization, the overall value of the market, to GDP, economic production. And the fact is that GDP is overstated in the way that it's counted because it includes government spending. It's not really about economic productivity. So that is now 88%, or it was in July, 88% higher than the long-term trend line. The fact is that when we get into these absolute extremes, then the clock is ticking, and it's only a matter of time before these things burst, and when they come down, they tend to come down in waves, but pretty violently. So we're at another historical extreme measurement at the present time. So here's another headline. The weakest we've ever witnessed. Morgan Stanley warning that crashing breadth will result in material correction. So they're talking about a crash. And what is breadth? It's the lowest percentage of stocks above the 50-day moving average. And that's the lowest since 1999, when the S&P hits a record. So this all indicates that something is happening soon. Now we've got the economic warnings. This is the industrial sector. As we see, the industrial sector rolled over between May and June of this year. This is an ugly chart. You're seeing the candlestick measures of the daily movements and the weekly movements on the charts, but you're also seeing the various coloured lines, and what happens is that those lines are moving averages. They're calculated on today's price plus a certain number of previous days. So the blue line is the 20 moving average, the red line is the 50, and the green line is the 200. So when the trends change, the candlesticks come crashing through those lines, and that's exactly what we started to see. Now we're looking at the materials sector, and what we're seeing is something even more dramatic, crashing through those moving averages, crashing through the 50 and heading rapidly towards the 200 day moving average. Now we're looking at consumer discretionary spending. Why is that important? It's a consumer economy in the United States. What we're seeing is that rolling over as well. We've also got these warnings: supermarket shelves empty as food supply chains are damaged. Well, these pictures aren't really representative of what's happening. They are just pictures to show what's happened in the past. However, what I saw in the UK recently was gaps in shelves, and what other people saw was staff running around rearranging the stock to hide the gaps in the shelves. And what I heard from a friend who's a supermarket manager saying that of 90 items supplied by one supplier, the supplier is saying, well, we're going to try and get you 45 of them, but we can't do 90. So Credit Suisse here is saying it's time to buy gold as a hedge against extreme financial deleveraging. What does that mean? It means when the markets unwind, leverage is where people take on bets that multiply, and that's great while the market's going up. You can bet that if a certain share or stock goes up by 1%, you'll take a 3 times leverage on it. Suddenly it goes up 1% in a day and you're 3% better off. Well, that's fantastic while it goes up month after month, week after week. When it reverses, then it's catastrophically damaging. So we have a number of crash indicators aligning for 2021, and we're going into this evidence in this particular video. And these crash indicators include cycles, so the rhythms of the markets, and the technical analysis, and the fundamentals. And I'm going to show you a sea change in banking as well, and another indicator, which is what the dumb money is doing, and what appears to be a leading indicator, indicating that problems are dead ahead this month. September, October, November in particular are flashing red alert. We have political factors coming into play as well, and the fact is there are always warnings, always, but people tend to ignore them while the markets are going up. But the markets, in terms of stocks and shares, are the tail, not the dog. The dog is the bond market. That's the debt market. Why? Because that's much bigger, and when a company is in distress, it's the bonds that get paid off first at the price of the equity. If they can't pay their bonds, they're bankrupt. So a bond is like a first call on a company in distress. We also know that markets drop more quickly than they rise, and that these are the best opportunities. So here's the flip side coming out. I recently read a book by Mike Maloney, an excellent book, Gold and Silver. He's absolutely an outstanding presenter, his charts, his information, his research, but also his YouTube channel. And what he pointed out is that thousands of times in history, over the last 4,000 to 5,000 years, which is all documented, what happens is that they have these experiments with fiat money, or trying to fudge the money system. And historically, until relatively recently, silver and gold were money. But when you have the fiat currency experiment, then when that goes out of kilter, when it collapses, the silver and gold prices revert to equaling the currency supply balance. And this is very important because 90% of all the dollars ever created were created in 2020. What does that mean? Well, you can do that for a while. It's like what Mark Twain said. How do you go bankrupt? Very slowly, and then all at once. This is what happens when a system changes. So the currency supply balance is going to have to revert to the gold value. So what we've got at the moment is a hyper bubble in stock markets and in housing and in fact in bonds as well. And the flip side of that is the counterplay to the markets, which is a hyper low in silver and gold. But the fact is, with long-term cycles, the averages always prevail. It's just a question of time. Michael Maloney also pointed out that silver is the indispensable metal. It has more uses and qualities, unique qualities, than any other metal. And at current usage rates, if all silver production stopped, the supply that there exists above ground at the moment would only last for 4 months. So gold and silver are the rarest metals in the Earth's crust, according to the United States Geological Survey. And silver, in fact, is the rarest. And it's got more uses than anything else. It's used in solar panels, it's used in wind turbines, it's used in computers, and it's used in electric cars, where the market is beginning to absolutely explode. So Mike Maloney also points out that the gold reserves in the earth will be exhausted in 30 years and silver in 25. And that's at current rates, assuming that things remain the same. When they're not, silver usage is increasing. So, the other evidence, the current mining ratio of silver to gold is 8 ounces of silver extracted for every 1 ounce of gold. And then we need to account for the historic silver to gold price ratio, which has been typically about 12 to 1, though it was 1 to 1 in ancient Egypt. But the current silver to gold ratio is 78 to 1. So that's an extreme. It's a historic extreme. And the fact is that the silver price is yet to exceed its 1980 high. So that's over 40 years ago. When the trend changes, this will absolutely explode. Mike Maloney also points out that 114 ounces of gold would equal the price of an average US house in 1980. And 1980 probably wasn't the best example. So the fact is, if silver only reverts back to its average, that would be 1,368 ounces of silver. And the fact is, in 1930s Germany, you could buy a whole city block in Berlin for only 25 ounces of gold. And again, at the historic average, that was 300 ounces of silver. The fact is that when markets flip and go into crisis, then there is potential to do much, much better, because houses, real estate, whole city blocks in Berlin are worth virtually nothing, when the thing that everyone wants is silver or gold to protect their wealth. So Mike Maloney explains the big cycles. 370,000 times the price in dollars could have been achieved through the following strategy. The Dow Jones Index bottomed in 1903, and if you'd thought, that's a bargain, it's unloved, no one wants the stock market anymore, you could have bought one share in each of those companies, and that would have cost you the equivalent of 1.5 ounces of gold. And all you needed to do was to ride up the market until you saw an obvious bubble. And that obvious bubble was recognised, not by everyone, but by a reasonable number of people in 1929. And by that stage, one share in the Dow Jones Index equaled 18 ounces of gold. But that wasn't where the dramatic moves came, because the stock market bottomed in 1932. And at that stage, 1 ounce of gold would buy you 9 shares. So you'd have basically moved out of the stock market in the bubble and bought gold, then waited for the stock market to bottom when gold was in its own bubble and moved back into the stock market. And if you'd held on till 1966, one share of the stock market would have then been worth 252 ounces of gold. This is the big waves, moving from one wave to another. And then by January 1980, 252 ounces of gold equaled 252 shares of the Dow Jones Index. But by 1999, 252 Dow Jones shares equaled over 11,000 ounces of gold. So you see that these waves get bigger and bigger and bigger through this multiplier effect. And in contrast, if you'd stayed in shares from 1903 to the year 2000, you'd have still had one share of the Dow Jones Index, which would have been valued at $11,000. So the fact is that gold has outperformed the stock market since the year 2000. And the implication is that the biggest and quickest gains are in the crises, the market drops. And this gives us potential to play a strategy, moving from something low to high. You buy low and you sell high. And here's what's been happening in the silver market and the gold market: price manipulation. So paper silver trading volume versus physical silver supply is at least 243 to 1. So for 1 ounce of silver, 243 paper ounces of silver are traded. And in total, 7.3 million tonnes of paper silver are traded annually in London and on the COMEX. This is from 2020. But there are only 3,060 tonnes of annual physical silver supply. So this paper silver has been used to suppress silver prices. What does that mean? It means if we've got an epic bubble in bonds and stocks and property and all the rest of it, then we have the complete opposite in physical silver supply. And it's happened through this paper mechanism. What does that mean in real terms? The precious metal is dirt cheap. So here's where it gets really interesting. Because if, as tends to happen when currency systems collapse or resets happen, the money supply and the revolving credit, things like loans and overdrafts, etc., comes to equal the price of gold, then in 2015 the price of gold would have been $18,000 an ounce, according to Mike Maloney, and he's an impeccable researcher. But in 2021 we'd now be looking at $24,000 an ounce gold, and this is the most conservative basis because there are many ways of measuring the money supply. I've heard figures of $50,000 and $100,000 mentioned. Now if we consider at the same time that if you now have $1,800 to put away, would you buy 1 ounce of gold or would you rather buy 78 ounces of silver? Well, to many people it will make sense to buy 78 ounces of silver, because if you need to sell some silver, you don't need to sell everything. You can sell 1 ounce at a time. And the implication for me is that silver will become a lot more attractive for people. And if that's the case, then I would also expect the silver to gold ratio to close. And I believe it could easily close to 10 to 1, given the fundamentals. And that would mean a 7.8 times increase, on top of a 13 times increase of a revaluation of gold to the money supply. And that would mean silver's potential would have 100 times potential from where it is here to increase. And the result of that is that $10,000 now in silver could equal $1 million during a reset. And if at the same time house prices and the stock market crash by, as has been forecast by quite a number of people now, 85 to 90%, then that means that you could get a 10 times leverage in buying power on that. And that means the value in buying power in property could then equal $10 million. The fact is that imbalance is always correct. And like a pendulum, they become their own bubbles. So the upside potential here is enormous. At this point, however, we also need to bear in mind the information from Bob Proctor coming later, which is that actually the gold and silver and commodities bottom could be happening next year. And if that's the case, I'd be very surprised if it went under the historical bottom over the last few years, in which case we could still be looking at quite a substantial drop in silver and gold, if it's actually available then. This is the work of Bob Proctor. He's looking at market cycles. And what he's noting is that there are 40-year cycles and 20-year cycles. And what we see is a high correlation between movements in the markets, lows at these particular points. Take a few moments to study the chart and just see how this works, how reliable it is. Bob Proctor also uses the Fibonacci sequence. And the Fibonacci sequence is adding 1 plus 1, and then 1 plus 1 is 2, and then 1 plus 2 is 3, and 2 plus 3 is 5, and 3 plus 5 is 8, and 5 plus 8 is 13, etc. This is a Fibonacci sequence. It's a natural sequence of numbers. It occurs throughout nature. It's a ratio as well, because the increase is 0.618 and the inverse is 1.618. Why is this important? Because this can also be applied to markets. Chris at Crypto is always using fibs. So is Da Vinci's J15. So let's have a look at Fibonacci now. The Fibonacci numbers in terms of years also correlate to the market. What we see at the bottom left of the chart is the beginning of the United States. And what we see is major turning points on these Fibonacci numbers over 233 years. And 233 years just happens to be the biggest applicable Fibonacci number. What does that mean? It means we're coming to the end of the system. And if you look closely, you'll see that there are turning points in the markets, significant ones, as regular as clockwork with these Fibonacci numbers. And what you'll see is that we're using smaller and smaller numbers as we get up to the top of the chart. 5, 3, 2, 1, and 1. Bob Proctor also uses Elliott Wave analysis. This is where stock markets are analysed in terms of waves. So, in Elliott Wave analysis, 5 waves make a larger trend. So if the trend is upwards, then we can expect 5 major waves upwards. And if you look to the left-hand side of the chart, what you'll see is the numbers in circles. The big wave up, number 1 in a circle, leading to a correction, number 2 in a circle, leading to the next wave up, number 3 in a circle, and then the next wave down, number 4 in a circle, and then the top wave, 5 in a circle. But between them, what you see is 3 waves of a lesser trend. So if you go back to the number 1 in a circle, you'll see A, B and C in brackets. This is the correction within the wave 1 to 2 sequence. And then what you see is, again, the larger trend applying. As we move from the 2 in the circle to the 3 in the circle, we've got 1 in brackets, 2, 3, 4, and the 5th wave. So whatever is the larger trend, whether it's up or down, tends to have 5 waves. And whatever is the counter trend has 3 waves. And this all connects to Fibonacci as well. At the bottom is that this also forms a Fibonacci sequence. 1, bottom right, on top, then moving to the middle, another 1, and then 2. If we move to the right again, then it's 3, then it's 5, then it's 8, etc. And this is the complete market cycle. Bob Proctor also points out that there is a commodities super cycle, a 90-year cycle. So this cycle goes back to 1933. And what we see is a bull and bear market between 1933 and the year 2020 in commodity prices. And what we see is the peak there in 2008, the big blow off top wave, and the bottom in 2020. And look at what that figure is. The retracement, the drop from the top, is minus 78.6%. And what's that? It's the square root of 0.618. It's a Fibonacci number. So the important thing here to note is the low in 2022 for Elliott Waves. And what this chart is showing is a nearly completed 89-year boom and bust in commodity prices from 1933, projected to 2022 plus or minus 1 year. So what's this saying? This is saying that the very bottom in commodity prices should be expected by 2022 plus or minus 1 year. And Bob Proctor has been absolutely bang on with a lot of his commodity forecasts regarding things like oil. This is very important information. The other thing that Bob Proctor points out is that commodities typically bottom out at a stock market bottom. What this is suggesting is that the bottom of the market came in the year 2020. So we've now got 2 different years and 2 different ways of pointing to the bottom of the commodity market. Cycles and Elliott Wave theory. So we've got a disparity, but only by a year or 2. But the fact is that cycles have dominated commodity markets. Have a close look at this chart. What we're seeing is the impact of wars in commodity prices, leading to big spikes. But if you look at the bottom of the chart, what you see is a 90-year cycle, 93 years between 1750 and 1843, which came 1 year after the stock market low, and then after another 90 years, 1933, 1 year after a stock market low. And now the projection, 2020 to 2023, where the stock market low, according to his other analysis, is due in 2022. The other thing that we can note is the way the chart changes after 1933. Why is that? Because the financial system was unleashed on the basis of debt. Until that time, the cycles applied completely. they kept on bringing the prices back to a norm. But in 1933, the dollar was decoupled from gold, and the result was this absolute boom in commodity prices. So this is long-term historical data that proves to be very accurate. If you've enjoyed the presentation so far, please watch parts 2 and 3, because it's a long presentation, but it does impact my personal strategy. It may impact yours. The information, I think, is extremely important, and I look forward to seeing you in video 2. Thank you for watching so far.